In today's video, I'm about to share with you why I prefer Arbor Realty over New Residential Investment Corp or NRC. Where New Residential has lagged the S&P 500, Arbor Realty has smashed it. Let's find out what the rest of the business looks like for Arbor and NRC, looking at the financials, dividends and valuation. Stick around to the end for a comprehensive look on their future. Always like to compare the market cap first. New Residential is the bigger company here, based on a market cap of almost 5 billion. Looking at the 5-year price performance, Arbor Realty did far better with a 130% price increase, while NRC actually dropped in price by over 30%. A lot of that has to do with absolutely terrifying plunge in share price of 80% in March of 2020. NRC is also much more volatile than Arbor Realty with a beta of 1.17, which isn't always a bad thing, but it just means more swings. The first round goes to Arbor Realty though, with a better beta and a better 5-year price performance. Arbor Realty is a popular mortgage REIT for its high dividend yield and high dividend growth, with a forward yield of almost 10% and a 5-year dividend growth rate of 17%. Arbor is a mortgage REIT or MREIT, and they are one of the US leading multifamily lenders and are partnered up with the biggest government-backed agencies like Freddie Mac and Fannie Mae. Most mortgage REITs typically have one income stream, leaving them vulnerable. Arbor is different than most mortgage REITs. They offer different product lines and thus are able to generate different income streams. They do balance sheet loan origination, GSE agency and private label loan origination, servicing of those loans, and single-family rentals. Let's see if New Residential, ticker NRC, can top that. New Residential is also a popular mortgage REIT that is often discussed. It was even more popular before they cut their dividend in 2020. Right now, NRC is yielding around 9.5%, but has a negative 5-year dividend growth rate due to the dividend cut in 2020. Although classified as a mortgage REIT, New Residential is more of a hybrid mortgage REIT, since, just like Arbor, they have a very diversified business. NRC originates its own mortgage loans, is servicing loans, and holds servicing rights. Just like Arbor Realty, they have recently gotten into the single-family rental business, and just acquired Genesis Capital to further diversify its business. With the acquisition, they will also now be able to offer construction, renovation, and other residential bridge loans. Time to dig into the numbers. Talking about swings, the dividends of NRC also swung in the wrong direction in 2020. It was absolutely crushed with a cut from 50 cents per share to 5 cents per share per quarter. To quote the CEO of NRC, Mike Nierenberg, as usual I will probably pronounce that wrong, market dislocations have put significant downward pressure on asset values. We have made a number of decisions to de-risk, increase liquidity, and protect our book value. In other words, they had to protect their business, which I respect. Since then, they have increased their dividends 4 times with quite a large amount already. But they are still at half the dividends per share of 25 cents compared to the 50 cents before. This gives NRC a rather large current yield of almost 10% though. Arbor Realty also increased their dividends numerous times in 2020 and 2021. The difference being that Arbor did not have to cut its dividend in 2020. They already had their turn during the Great Recession with a 100% dividend cut and a 96% decrease in share price. Because of that, Arbor Realty has a dividend growth history of 9 years now. The dividend cuts of both these mortgage REITs thus illustrate the inherent risk with investing in MREITs, as the 80 and 96% decrease in share price is not for the faint-hearted.
Oh, it went to 0!
Then we get to the payout ratio. After the last episode about Arbor Realty, I received a question on how to look at the profits of a mortgage REIT, since typically you look at the FFO and AFFO metrics to understand the profitability of a REIT. Mortgage REITs differ from equity REITs because the latter owns the actual properties and receives rental income on that, while mortgage REITs do not own the properties but the financing vehicles behind it. With owning buildings comes a lot of depreciation, a non-cash charge that is only covered in the books. Mortgage REITs don't have that since they don't own the properties, so for mortgage REITs we look at the earnings per share metrics instead. Arbor Realty only pays around 70% of its profits in dividends, which is very good for a REIT. New Residential has an even lower ratio though, as they only pay out 60% of their profits. Arbor does score better on the dividend safety score though, with a score of 50, which is still not great. New Residential has a score of only 30 though, meaning unsafe. This round would be a tie because NRC has a higher dividend yield and a lower payout ratio, but both are the result of poor performance dividend-wise and price-wise. As I am a dividend growth investor who likes stable dividends, Arbor wins this round with a better dividend growth rate and a better dividend safety score. There are companies that benefited greatly from the current health situation, and there are companies that got the worst of it. Looking at the net income of NRC, it looks like New Residential got absolutely smashed in 2020 with a loss of 1.4 billion. But that is not the whole story, because the earnings per share are positive. So what's going on here? New Residential uses a metric called core earnings to judge their performance, which adds back a few items to the net income. The main items are impairments and unrealized and realized gains and losses. Luckily, New Residential explains this very well in their quarterly reports. And the core earnings are what we see here. What I don't like is that the earnings seem to be trending down, even before 2020. So it would be interesting to see if they are able to reverse that trend long term. Arbor Realty on the other hand has a steady uptrending earnings per share. With that, Arbor also wins this round. Another important component to analyze with mortgage REITs is their debt, because debt and raising money through equity is a major part of how these mortgage REITs grow. This video is sponsored by Freedom24, a European broker that allows you to buy stocks on all the big exchanges, offers a 3% yield on their bank accounts, and allows you to easily get in on IPOs. Get your free stock worth up to $600 by clicking on the link in the description. Back to scheduled programming. Arbor Realty and New Residential both have an increasing pile of debt, and they have the same net debt to capital ratio of 0.82. Which measures how dependent the company is on using debt to fund their operations. Another way mortgage REITs fund their operations is through raising additional equity. In other words, by increasing the shares outstanding. This obviously means that existing shareholders are entitled to a lesser piece of the profits, since the company is split up into more pieces when that happens. Both Arbor and New Residential also have an increasing amount of shares outstanding. The differentiating factor here is what they do with that extra capital though. This can be measured by looking at earnings per share, and as we have seen, Arbor has increasing earnings per share, while NRC has decreasing earnings per share in the last few years. Based on that, Arbor seems to be better at putting that capital to work, and thus they also win this round. Now, to further isolate how well these companies are with turning cash into returns, we can also look at the return on equity, measuring how much profit a company is able to generate for every dollar that is invested in them. New Residential has had higher returns on equity than Arbor in some years, but it is quite erratic and went negative in 2020. Arbor is more steady around the 10 to 15% range with a positive outlier of the last 12 months. With that, Arbor also wins this round. As a value investor, I also like to know if a company is undervalued or, in other words, on sale. Fast Graphs shows Arbor right around the blue line, so right around how the market has historically valued Arbor Realty. The predicted annual return until the end of 2023 is right around 8%. And this is where New Residential absolutely blows Arbor out of the water with an expected annual return of 29%. This mainly has to do with analyst expectations for NRZ. More on that later. Finbox has a fair value of $21 for Arbor and an upside of 23%. New Residential shows a fair value of 12.74, an almost 23% upside as well. So they are quite close in this round, but since NRC shows such a big upside on fast graphs, NRC actually wins this round. There is one thing we haven't yet looked at though. We have looked at the past price performance, market cap, dividends, financials and valuation. But these are mostly indicators of past performance. What about the future? The overall residential mortgage market is expected to keep growing due to significant pent-up demand. Both Arbor Realty and New Residential are focusing more on the single-family rental market, since more institutional capital is moving to that space, providing a lot of opportunity. With the recent acquisition of Genesis, New Residential adds a new complementary business to their portfolio. The strategy behind this for New Residential is to offer both a more diverse stream of leads coming from the single-family rental space, as well as creating cross-sell opportunities to fuel their mortgage origination platform. The acquisition also increases the geographical footprint of New Residential. This acquisition is in line with their business transformation strategy to expand their less risky operating business. Then Arbor Realty. Just like NRZ, Arbor sees a lot of opportunity in single-family rental market and expects the market to be at least as big as the multifamily market. On top of that, Arbor has a big structured loan business which they expect will continue to grow. Purely looking at the future growth numbers, NRZ is predicted to do far better, with an annual increase of 20% in earnings than Arbor according to analyst expectations on fast graphs. Overall, NRZ got absolutely smashed in this battle, but it is not this black and white in reality, of course. If you do believe in the future growth story of new residential, then it might certainly be a good choice to look at. Check out this video on Arbor Realty to get an even more in-depth view on the company.